Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Asian stocks on the cusp of an intraday record high after U.S. and global benchmarks hit fresh peaks as the Fed's rate cut boosts sentiment. Investors closely watching a much-anticipated call between U.S. President Donald Trump and China's Xi Jinping later today. Traders looking for signs of easing trade tensions between the world's two biggest economies. And Nvidia agrees to invest $5 billion in Intel to co-develop chips for PCs and data centers. This raises the value of the U.S. government stake to $13 billion. Well, it's just gone 8 a.m. across the Emirates. I'm Ziyanda Stuurman in Dubai. Let me tell you, these markets are buoyant for the first time since 2021. You had the S&P, the Nasdaq, the Dow, and the Russell 2000 all make record highs on the same day. That all happened yesterday, the day after the Fed. So cemented, obviously, that the dovish easing cycle by the end of this year. That was a boon for stock markets. But then also later in the day, we got this news that Nvidia had put in a stake, an investment stake into Intel. That turbocharged Intel. The stock was up like something 25% yesterday and also gave a lot of momentum to the tech sector as a whole. So this morning, you're seeing some of that positivity seep through once again. S&P futures up 5. Today, I'm bringing up Russell small cap index because, you know, for so long this year, we've been talking about how the rally in the U.S. has been centered around the Magnificent Seven. And what we're starting to see, at least, you know, in the last couple of weeks, is a broadening to a certain degree. And what you saw yesterday was a participation of the smaller caps. So Russell 2000 also leaning and at an all-time record high. USD slipping this morning, down 3 basis points. Remember, we saw a brief bid for the greenback after that Fed meeting. It didn't last very long. For the week as a whole, the dollar is still weaker. So we're down about 0.3% for the week. Remember, we're tracking losses of more than 10% for the year there. And then 10-year yields back up again at 4.11. We did have surprisingly strong jobless claims data coming through yesterday. Somewhat of a surprise given all of the discussion around the weakness in the U.S. labor market. Jobless claims yesterday, however, surprisingly strong versus expectations. And on the back of that, you saw a backup of U.S. yields. But it was not just about the Fed and, of course, not just about the Bank of England yesterday, which I didn't mention, a bit of a tapering announcement there. But we also had the Bank of Japan decision come through just a couple of minutes ago. And about maybe just walk us through some of the highlights. They did not cut interest rates, but a tapering of some sorts out of Bank of Japan as well.
Yeah, that's exactly right. I mean, we surveyed 50 economists for this central bank meeting, so that every single one of them was saying that they would stand pat today. That's exactly what's just happened in the last 10 minutes. But as you said, it also is that plan around the ETF selling that's also driving market sentiment today. But in terms of the market reaction, are you seeing that yen strength coming through? You mentioned, of course, we have seen dollar moves over the course of this week with the Fed, but also what we're seeing with yields here. Again, they're continuing to rise. Stocks here a little bit under pressure, and that's actually interesting because they have spent much of the session in positive territory. But as you said, it's that plan around offloading ETFs. They're planning to sell around 330 billion yen of ETFs per year. That is one of the key takeaways out of the decision so far. What else is interesting to note, of course, because that's sort of the headline level, but let's also take a look at this chart here because we do have the Wader press conference coming up later today. Going to be really interesting what he indicates in terms of any sort of sentiment we get or any sort of indications on when the next hike could be. So we've done this survey. I mean, everyone basically is expecting a hike by January of next year. Some are saying October maybe could be likely. One of the really big complicating factors, though, of course, is political uncertainty because you've got that leadership race taking place in Japan right now after Ishiba announced his resignation, and that is due to conclude October 4. So again, coming up very close to the next BOJ meeting. But then again, that is the expectations around the next hike.
Yeah. I would say also one other thing that the markets are clinging to here is the fact that there were two dissenters calling for a hike. So that perhaps brings forward the timing of the expectation for that first hike as well. Belle, thank you so much. Another interesting statistic from our T-Live page, and just to give you context for exactly the size of the ETFs that the Bank of Japan holds. The Bank of Japan has around 70 trillion yen in ETFs. At the announced pace of 620 billion yen a year, it will take them 112 years to sell them all. So yes, there is a tapering announcement, but the starting point is the balance sheet is huge to begin with. So that is on the Bank of Japan. All right, President Trump has indicated he may further extend the trade truce with China when he speaks later on Friday with President Xi Jinping. The call will be the first direct engagement since June between the two leaders, and the issue of a TikTok sale should be high on the agenda. Let's bring in our chief North Asia correspondent, Stephen Engel. So earlier this week, we were talking about the contours of that TikTok deal. We got a little bit more information about the consortium of U.S. companies that might be involved in it. What is on slate for the call today? Is it to package up the TikTok deal, or could there also be some discussion around trade as well?
Well, there's definitely going to be discussion around trade, national security issues, and the whole bucket of differences that they have. The reason why TikTok has gone up to the top of the agenda is like it's much closer to a possible resolution than all those other major fundamental issues, no doubt. So it's a deliverable, and it's just how amenable the two leaders will be to selling this to U.S. interests as demanded by the U.S. And Trump has already indicated if they don't get a deal and then essentially over the phone ratified by Donald Trump in about 9 hours from now, he's willing to walk away. But not really. I mean, he's playing both cards, really. He's also said essentially that this could potentially be valued in tens of billions of dollars. You don't want to throw that kind of value out the window. We need details on who's going to own and control the algorithms and the data. And again, more about that ownership structure.
You know, when we spoke about this earlier in the week, we were saying that from what we understand, ByteDance's stake in TikTok would go down below 20%. So you could say to a certain extent that China have offered a concession to the U.S. Is that perhaps positioning themselves to get something back in return from the U.S. vis-a-vis these trade discussions, potentially on tariffs or even on export controls and barrier controls?
You know, Donald Trump is a transactional president, right? He negotiates with these bargaining chips, and China does too, maybe even tenfold. So absolutely, China will maybe give something to get something in return. And, you know, up until now, they've kept their cards, to continue the poker analogy, close to their vest on TikTok, other than they've given no indication that they actually want to sell this. So there must be something in there that they're willing to offer. Maybe it's a licensing agreement as well to the United States. We simply don't know. We need the devil in the details to come forth after this phone call or once they decide to move this forward, if they do. But again, there's all kinds of give and take right now on soybeans, on rare earths, which jumped to a record in August, on exports, on Boeing airplanes, so many different things, including that Google Android investigation we're hearing has been scrapped as sort of a gift from China to the Trump administration.
Yeah, that broke yesterday on our show as well. So all of these things to watch out for. Big phone call coming up later today. Bloomberg's chief North Asia correspondent, Stephen Engel. Okay, let's get back to the market action with Ryan Lemand, co-founder and CEO at Neovision Wealth Management. So many issues to go through. Maybe let's just start with global markets and the fact that U.S. markets are so buoyant. You have all of those four majors reaching all-time record highs. You could say a similar thing about MSCI Asia Pacific as well. Happy days for equity investors, it would seem.
Absolutely. And as you said in your LinkedIn post a couple of days ago, Jerome Powell and the Federal Reserve has given everyone something to chew on, the bears and the bulls. But everything favors today more rises in the U.S. equities. It's favoring it. M2 monetary basis at the highs, everything at the highs. It seems positive. Nvidia investing into Intel, more data centers, more AI adoption. So absolutely, everything is going up.
Yeah, what's going to go wrong?
What's going to go wrong, might go wrong, in my opinion, is AI adoption again. It's the strength and weakness. If you go back to year 2000, internet, we thought in year 2000, that's it. Everything is just fly and go to the moon. However, we discovered later on that actually integrating internet will take time. It actually took 10 to 15 years to come to the Internet of Things. So AI today, yes, we're using it on a daily basis, but is it really integrated? Has it really changed our lives? I don't think so. We're at least 5 to 7 years away from that.
And yet, anything that is tangentially exposed to artificial intelligence has been doing phenomenally well. So you're cautious of that?
Absolutely. Just like year 2000. Everything was going up back then. Today, it's the same thing. AI is the future. I'm not denying that.
The difference back in 2000 is people were plowing money into non-profitable companies. The difference with the big, magnificent seven, or at least, the major stocks, the outperforming ones, the top three, is they are extremely profitable, and you are seeing very strong revenue growth, 20, 30%, and other businesses would be very envious of that type of growth. So the growth profile is actually there, and so is the profitability.
100%. Cisco in year 2000 was the only routers manufacturer. It was very profitable as well, but still, it dropped. Microsoft was very profitable. From year 2000, it took 16 years for the Microsoft stock price to go back to par. Yes, absolutely. Profitability is very encouraging today, but is AI really integrated? Are we there yet? No, we're 5 years away.
For an investor, we speak to a lot of people who manage retail money, family office money, and everyone wants to be somehow exposed to the AI trade. If you're not in it, there must be a certain degree of FOMO. You won't be beating the benchmarks. You'll be underperforming the benchmarks for a very long time. So then how do you position the portfolio? How do you explain the underperformance?
Well, we've beat the benchmark without having exposure to these stocks. So our model portfolio has made 27% year to date without any U.S. exposure. Chinese stocks, as you know, we've bet on it quite early. Gold, Swiss stocks, dividend-paying stocks, some cherry-picked UK and European companies. We've done 27% year to date. Do you want to talk about the U.S.? Build-A-Bear company, its stock has beaten Nvidia stock year to date, since 5 years actually. Domino's Pizza, look at the performance. So there are stocks that are beating AI stocks, but yes, should people invest into AI? Absolutely, hands down.
Yeah. Gold, ever since I've been speaking to you, at least for the better part of this year, you've been a gold bull. We are, 3,700 is where we are. What is your target? How far more? How much longer do you think this bull rally can be sustained for?
Our target is not a time stamp. It's actually all of these parameters that are pushing gold up that are making us continue to be bullish on gold. So it's a continuous trade.
What do you think could derail the price of gold from here? Because one thing that we've spoken about a lot is, geopolitical uncertainties. That has been, one catalyst for people to put money in, the opaqueness of the economic outlook in the U.S. But as things start to look up there, would you not perhaps see money withdrawn, the money that was put in, as a safe haven hedge? Would you not see some of that money come back out again because there's less conviction about, wanting to be positioned in some of these defensive trades?
So there are 5 or 6 parameters that have pushed gold up. One of them is U.S. dollar dropping in value versus gold rather than gold going up in price. This is how we see it, the other way around. So one of these factors is China being the manufacturer and the U.S. being the consumer. Neither of these can beat the other. If they agree, yes, this would remove a big element of gold going up, because then China would go back to potentially buying treasuries and having US dollar as a reserve. So that's one element. People withdrawing, I doubt. People would just stop buying and just maintain. Potentially some of them might withdraw, but gold going back to 2,500 or below, that's very, very much unlikely.
Is there a target? Do you have a target?
Well, the first target is 4,000 before the end of the year.
Yeah. Okay. We probably might get there, given the extent of the performance. Ryan, always good to chat to you. Ryan Lemand, co-founder and CEO at Neovision Wealth Management. Well, coming up, a surprise $5 billion deal as Nvidia teams up with Intel to co-develop next-gen chips for PCs and data centers. What it means for the future of computing and why this could reshape the tech landscape next. This is Bloomberg. Intel shares soared after Nvidia agreed to invest $5 billion in the chipmaker. Nvidia CEO Jensen Huang says the deal presents an opportunity that could be worth $50 billion a year for both companies.
We thought it was going to be such an incredible investment. This is a big partnership, and we think it's going to be fantastic for Intel. It's going to be fantastic for us. And we're building revolutionary products that's going to address some $50 billion annual market. And so how could we, on the one hand, be excited about the products and how revolutionary they are, on the other hand, not be excited about the opportunities ahead? And so we're delighted to be a shareholder. We're delighted to have invested in Intel. And the return on that investment is going to be fantastic.
A remarkable announcement that came through yesterday afternoon. You saw a massive spike in Intel stock as well. Bloomberg Intelligence senior analyst Robert Lee joins us more. Who is the winner here? I mean, obviously, you know, a knee-jerk reaction, very positive for Intel, but is this a win-win situation for both Nvidia and Intel?
Okay, well, Intel's a clear winner of this. There's been a lot of talk in the press about them being thrown a lifeline, but don't forget, the US government put, I think it was $5.7 billion into them several weeks ago. There was also a $2 billion investment from SoftBank as well. So, you know, these cash injections will help secure and stabilize the financial position of Intel going forward. Also sends a very strong message of support, you know, a sort of coalescence of the willing companies, which are all well positioned with significant and meaningful stake in the future of the US technology sector. So on that basis, I think it is positive. What exactly Nvidia gets out of it, far be it from me to criticize Jensen Huang. You know, he's a great engineer, a great evangelist, and a great salesman, I would say. So I think it's hard to see, you know, what the near-term return is going to be. Obviously, if Intel stock continues to go up, maybe there's a financial return to make. But I don't think the impact on Nvidia's business is overly significant. That's why Nvidia stock, I think, was up only 3% on this news.
Yeah, I mean, it wasn't that long ago. It was, what, a couple of weeks ago when President Trump was taking aim at the Intel CEO. And what a couple of weeks it's been for Intel. First, they got the U.S. government stake. Now, the Nvidia stake. Is this the end of its troubles, so to speak?
I'm afraid not, because, again, these cash injections help stabilize the financial position of the business. So that is a positive. But Intel is a company that needs to get back on the growth curve because, and it's something they've tried to do really over the last 20 years. As you probably appreciate, the core of what they do is selling specialist chips that go into PCs, laptops and servers. You know, they are dominant there or have been dominant historically, but those markets are not growth sectors. So over the years, they've tried to get into foundry. They've failed to compete with TSMC in any effective way, and they've actually lost their technology leadership to TSMC. Then they've tried to get into mobile phones and smartphones. That didn't really work. And obviously, they missed the AI boom. So the key thing that Intel needs to do is to address a growth market, but taking a step back from their business, from the headlines, I should say. You know, I think they're too thinly stretched. They're trying to maintain some sort of position in foundry and on the physical fabrication of the chips and also on the design. And I would have said their relative strength these days lies more in design, and maybe that's where Nvidia's interest is. So the question I'm coming to is, will we ultimately see a separation of the two businesses with Intel along the lines of what AMD did several years ago when it hived off its manufacturing business into what became Global Foundries? I still think that is a distinct possibility.
Yeah, something we'll watch out for. Bloomberg Intelligence senior analyst Robert Lee, thanks so much. And coming up, Uganda's public debt soars after stringent anti-LGBTQI laws restricted access to low-cost funding from abroad. We'll have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Uganda's public debt has ballooned after stringent anti-LGBTQI laws restricted access to low-cost funding from abroad. Domestic debt jumped by 26% in the financial year that ended in June to $32.3 billion. For more on this, Bloomberg's Ondiro Ganga joins us now from Kigali, Rwanda. Really significant numbers there, and the fact that there's been somewhat of a funding freeze that's been playing out with Uganda from international sources of money. Is this why they have had to resort to domestic markets?
Absolutely, Jumana. And just for context, Uganda passed a very controversial anti-LGBTQ law that carried the death penalty for aggravated homosexuality. And because of this, we saw not only the World Bank, but many other international organizations freeze their funding. But they felt the pinch the most, particularly with the World Bank. And as a result, they've had to resort to alternative sources of financing. And they're borrowing from the domestic market. They're borrowing aggressively. Actually, if you look at public debt, it ballooned by 26%. And over 50% of that came from the domestic market, with only 6% coming from the international market. So that shows you just how much the government has been leaning on the domestic market to be able to finance government services and also projects. And now independent analysts are pointing that there could be holes and issues with this because, one, this is money that is not coming with the same scrutiny, checks and balances like concessional financing from the World Bank and IMF. And the risk that this poses is that public finance might not be able to deliver quality investment for the projects that the government will undertake, all while ballooning public debt. The other downside is they're locking out the private sector from financing. You know, the risk that comes with government is very minimal, and so the banks will gravitate towards them. And this is locking out the private sector from getting financing. But outside of that, it's really good news that the World Bank is lifting this freeze because they have big infrastructure projects, airport, railway, and a crude pipeline that will be about $900 million, so they need this.
So would you say that the funding freeze actually achieved its purpose? Because there are other countries in Africa also looking to implement similar anti-LGBTQI laws as well.
Absolutely, Jumana. Just the first 6 months after this law was passed, because it was passed in May, by October, a report had come out by Open for Business saying that it had cost the country over $1.5 billion. And they were saying that if this trend continues over the next 5 years, cumulatively, the country would lose about 3.2% of their GDP, bringing it to about $8.3 billion. They would have lost about $1 billion in terms of international aid that comes into the country, donor financing, foreign direct investment. And so we've seen Uganda feel that pain, not only from passing this law, but also from the future downfall that could come if they continue to uphold this law. And like you mentioned, other countries have tried it. We saw Ghana try it, and very quickly, the Ministry of Finance wrote to Parliament saying this could jeopardize $3.8 billion from the World Bank, $3 billion IMF bailout program, and $20 billion debt restructuring. And so we saw the previous administration dragging their feet, and Mahama administration will not be touching this. So the pinch point is very clear.
Yeah. Bloomberg's Ondiro Ganga, thank you so much for the reporting there. Well, coming up, we'll talk to Malik, the chief economist at Abu Dhabi Commercial Bank, as Arab Gulf states also follow the Fed in cutting interest rates. That's next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Investors closely watching a much-anticipated call between U.S. President Donald Trump and China's Xi Jinping later today. Traders looking for signs of easing trade tensions between the world's two biggest economies. Nvidia agrees to invest $5 billion in Intel to co-develop chips for PCs and data centers. This raises the value of the U.S. government stake to $13 billion. And we speak to Ziyanda Stuurman, advisor at the Africa practice, as South Africa and the U.S. look to make progress towards a trade deal. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, it's been quite an action-packed week. So much going on beyond the Fed. Other meetings as well. We had Bank of Japan this morning, unchanged, but still announcing a sell-down of their ETF portfolio. Yesterday, the Bank of England also announcing a tapering too. So it's not all about the Fed, but of course, the Fed is what caught the limelight yesterday, and we saw a very strong reaction Wall Street. I spoke about this at the top of the show. All four of the majors in the U.S. making a record high on the same day. Coincidentally, the last time that happened was back in 2021. Today, also leaning slightly positive. Look, the S&P is just shy of 6,700 here, futures. Russell 2000, that is the small cap index, also leaning towards the green. Yesterday, making an all-time record high. The USD slipping for the week. week, we are still softer despite the marginal uptick we got after the Fed meeting. And then 10-year yields in the U.S., we backed up a little bit yesterday after jobless claims data came through stronger than expected. 4.12 is where we're at. Remember, briefly after the Fed meeting, we broke through 4% to the downside. We're now up 15 basis points since that happened. Okay, let's also check in on how markets in Asia are faring. Annabelle Jewelers in our Hong Kong studio. So Bank of Japan and more on your radar today.
Yeah, well, it's really just the Bank of Japan, as you said. We got that decision in the last 40 minutes or so, and it's actually been interesting to monitor the market moves. I mean, the Nikkei, for instance, you can see it's really starting to accelerate those losses, and that was also because we saw a lot of optimism when it came online this morning, when you've got names there that are very much linked to the Intel story and the broader tech optimism we saw overnight. But again, you're turning in the red here. Otherwise, you're also seeing that yen strength, and you're seeing a move higher in bond yields as well. So overall, as you said, they kept their overnight call rate at 0.5%. That decision was expected by every single economist we surveyed, and we surveyed 50 of them. So this was very much the consensus going into it. But what's important to note, as you said, we did get that first ever mention of their plans around their ETF holdings, and they're going to look to sell those down. Of course, the BOJ has become a very big holder of Japanese equities, Japanese bonds, rather ETFs, and bonds, but essentially they're looking to sell off around 330 billion yen per year of those. It is that big sort of macro question. The BOJ says they're still continuing to assess those economic uncertainties. They still see global headwinds as well, and they have quite a bearish outlook on the broader global economy as well, even though, interesting to note, you saw the Fed upgrading their growth forecast yesterday. But let's take a look at what we're expecting here, because we've got that presser coming up, and it's going to be a very interesting to note the tone that the Governor Wader strikes, because he has been known to be someone that when the BOJ holds, he actually strikes kind of dovish tone in the presser. Anything we get on the timing or commentary around the timing of the next hike is going to be critical. Some, or around a third, are saying it could come in October. As you said before, the important thing as well out of this meeting is we've got 2 dissenters out of 7. That's the first time a Wader's seen that as well. So does that bring it forward, these expectations for the hike? Everyone's basically expecting it that we surveyed by January.
Belle, thank you so much. Annabelle Jewelers in Hong Kong. Now, Gulf states have cut their interest rates in response to the Fed's first rate cut this year to maintain their currencies pegged to the U.S. dollar. The 25 basis point cut also aims to stimulate credit demand and the housing sector. Joining us is Monica Malik, Chief Economist at Abu Dhabi Commercial Bank. Good to have you with us, Monica. Obviously, when the Fed cut interest rates by 25 basis points, the GCC countries follow suit because their currencies are pegged. A 25 basis point cut, does that constitute a meaningful monetary loosening for the countries of the Gulf?
Good morning, Jemana. A single 25 basis points rate cut will by itself not have much of a difference. But what is critical to us is that inflation is much lower in the region. Interest rates are much higher than they need to be. And now with the weakening of the data in the US, we in the market are expecting a greater rate cutting cycle than expected a few months back. So in total, we're expecting 2 further rate cuts this year and 2 further in the first half of next year. And the cumulative effect of these rate cuts, we believe, will be important in 2026.
Now, easier policy often means that domestic demand picks up. There's a read across to inflation. How are you seeing that channel be transmitted throughout the Gulf?
So far, underlying price pressures are quite weak. If we look at the countries that do have a slightly higher inflation rate in the Gulf, it's namely Saudi Arabia and within the UAE, Dubai. And critical for that is non-tradable. So if we look at really the underlying price pressures, those are quite muted, despite the weakening of the US dollar that we've seen, and thus the weakening of GCC currencies. So given the fact that we do have a lower oil price backdrop, we believe that this will be positive for consumption, and it's not really going to stoke inflationary pressures, and there's still margin, very comfortable inflation backdrop.
Yeah, one of the phenomena that's occurring is tight liquidity conditions in Saudi, but particularly for Saudi banks, where there's immense competition over deposits. Does this alleviate some of those funding concerns in Saudi Arabia?
Not so much alleviate funding concerns. Well, to a degree, what we have seen is that since the market started pricing in deeper rate cuts by the US, we did see Saudi Arabia government, PIF, and Saudi Aramco all tap the international debt capital market. So this access to external borrowing is very important, and the lower cost of borrowing is critical for that. But again, if we see domestic credit demand pick up, that could add to liquidity pressures if consumer demand picks up. But we have also seen Saudi banks issue debt internationally, and that will be critical to keep funding pressures in check.
Yeah. What is your outlook for the bond issuance that's been coming out of Saudi Arabia? I mean, there's been plenty of it, but at the same time, you know, you're looking at credit spreads and they keep tightening. You look at the bond yields, they keep trending lower. Can that continue?
Well, I think I do see more space for that. I do see as the rate expectations, especially going into next year, filter into the market, that it'll be positive for Saudi Arabia. Critically, from a macro perspective, we continue to see fiscal deficits this year and next year. At the same time, while there has been recalibration of projects, the investment program is continuing, and funding for that will be critical. So we think not only from the government but by quasi-government, the borrowing requirement will remain large, and the lower cost of borrowing is positive from that front.
Yeah, I want to bring it back actually to the UAE, and I just wonder whether you're seeing any signs of overheating either in financial markets or perhaps in the real estate segment, now that this is also being accompanied by a lower backdrop to interest rates.
Indeed, and we've seen very strong demand continuing in the real estate market. But in line with that, even though the price growth has been slowing, there has been significant price appreciation, and that's affecting the affordability. So the interest rates cuts are positive for that. It's positive for individuals who want to buy their first property and see a more long-term future. We've seen very strong demand from cash purchases. So overall, we don't expect to see an overheating in the real estate market. In fact, we see the price supply growth being as very much needed, and any contained dampening of price pressures actually will be positive for longer term competitiveness in our view.
So interesting. Monica, Malik, always good to chat to you. Thanks so much for joining our show. Chief Economist at Abu Dhabi Commercial Bank. Now for a look at some of the other stories we're following. The U.S. has vetoed a UN Security Council resolution demanding an immediate ceasefire in Gaza that was backed by all other members of the body. This is the sixth time the U.S. has vetoed a Gaza resolution since 2023 and underlines American and Israeli isolation over the war. U.S. Councilor Morgan Ortagus says the resolution failed to adequately condemn Hamas. German Chancellor Friedrich Merz says his government will make a decision in the coming days about a European Union push to suspend Israel's preferential trade benefits. The EU proposal comes in response to the worsening humanitarian situation in Gaza. Merz says he and Spanish Prime Minister Pedro Sanchez share deep concern about Israel's offensive, but he reiterated Germany's position that it is not ready to recognize Palestinian statehood. And coming up, we will be speaking to Ziyanda Stuurman, advisor at Africa Practice, about the U.S.-South Africa trade talks. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. South African President Cyril Ramaphosa says that formal negotiations with the U.S. is a sign of progress towards forging a trade deal with the country's second largest trading partner. South African Trade Minister Parks Tau held a cordial and constructive meeting with U.S. Trade Representative Jamison Greer in Washington to resolve an impasse over tariffs. South Africa has submitted a new proposal to the Trump administration to lower the tariffs, which threaten the country's auto and agricultural exports. Joining me now is Ziyanda Stuurman, advisor at the Africa Practice, and our chief Africa correspondent Jennifer Zabazaja also joins the conversation. Ziyanda, really good to have you with us. Let's just talk about the trade talks, the fact that the Trade and Industry Minister Tau was in the U.S. having these conversations, hoping to perhaps take down or bring down that 30% reciprocal tariff rate that the U.S. imposed, one of the highest around the world. Is it the expectation that South Africa will have to offer many more concessions in order to convince the Trump administration to bring down that tariff rate?
Yeah, I mean, I think, the broad conversation around South Africa's and the negotiations around South Africa's tariffs are really at this point at an impasse to a certain extent. I think the South Africans have offered a number of concessions, both in industry and sectors, ranging from agriculture to critical minerals to energy. But ultimately, the Trump administration has really been pushing far more on the domestic political side. And this has to do with legislation around land ownership, and what's called land reform in South Africa in terms of transferring ownership in that sense, as well as then triple BEE or broad-based black economic empowerment laws that the US is not in favor of. So ultimately, the question here isn't just about the hard trade of this in terms of sectoral agreements and negotiations in that sense. There is a much bigger political, foreign policy and diplomatic effort underway as well.
Ziyanda, this is Jennifer here in Johannesburg. Overnight, we did hear Mark Carney from Canada saying that any trade deal with the U.S. should be in Canada's best interest. I wonder if you think South Africa should potentially take a stronger stance when negotiating, or would that just backfire at this point?
I think that, that's a very nuanced question and really comes from the fact that South Africa has really held back in terms of any retaliatory action at this point. But that hasn't necessarily yielded positive results for South Africa. So I would really say that South Africa's negotiators are at a crossroads where, again, very comprehensive trade deal and framework has been put forward, but has been ultimately either rejected, rebuffed, or told is not enough. So, the next few weeks are going to be deeply critical, again, not just because of the trade factor, but some of those political factors I was talking about. And this is reflective of the scenario playing out between the US and Brazil, for example, and the US and India, where trade is for sure at the heart of those relationships and negotiations at this point. But just like South Africa, there's a much wider context that needs to be taken into account.
And it's not just the trade repercussions, but also earlier this year, the U.S. imposed funding freezes as well, USAID. And there has been a lot of talk within South Africa about the impact that these funding freezes are having. Is there any hope of a climb down in that respect? And could they be somehow weaved into the broader discussion around U.S.-South Africa relations?
I don't think at this point that there will be a reversal, particularly around USAID funding and other channels of funding in South Africa. The one program that has been spared is the PEPFAR public health funding program, and that is also particularly because South Africa has been one of the highest recipients of those funds over the last 20 to 30 years. But very broadly, the South African government, through its own revenue, sort of changes or tweaks, plus additional, whether it's donor or philanthropic funding, has really been able to plug a lot of gaps in development funding. So I think that conversation in many ways is closed, and South Africa has found alternatives in that sense. The trade issue, though, is really at the heart of this, because it is so difficult for a number of South African exporters, particularly in the agricultural and automotive sectors, to find new markets that are not the US.
Ziyanda, what about AGOA, the African Growth and Opportunity Act, that's meant to expire later this month? Should that potentially be factored in? If there isn't a deal to be made on lowering 30%, should the focus then be on AGOA and potentially even G20 and the discussions that could happen there?
Yeah, those are good questions, and I think particularly around AGOA, I often say to look at the frame of AGOA for Southern Africa. There are a number of Southern African countries that are AGOA eligible, and many of them are pretty small and therefore use South Africa's export infrastructure to move goods to the US. So it is a tricky scenario in which, of course, South Africa would like to retain AGOA status, and will definitely argue that it should, given that so many of the AGOA eligible countries in Southern Africa are tied to and rely on infrastructure across South African rail networks as well as ports. So I think you could see a scenario in which that plays into the calculations of whether South Africa retains its AGOA status. And of course, importantly, South Africa is also the US's largest African trading partner. So there is that question of, what type of AGOA exists without, again, South Africa in it.
And Ziyanda, just finally, what would you say is the worst case scenario here? Do you think we're currently at it, or could we potentially see this getting even more detrimental for South Africa, potentially sanctions on the table? How would you sort of factor this in if you were advising the presidency?
So I do think things could get worse, unfortunately. There are two pieces of legislation right now in the US Congress that would target sanctions at ANC leaders and in some respects government officials. So you have a scenario in which in the House a bill was introduced in late July, and that was particularly around a review of the South Africa-US bilateral relationship, with the implication that should this comprehensive review take place and officials are found in contravention of what's called the Global Magnitsky Law, that there may be sanctions placed against them. Just this past week, a companion bill was introduced in the Senate, and of course the timing of that does feel deliberate, given that there's a large South African delegation in the US right now and will be on the sidelines of the UN General Assembly. So my advice really would be, at this point, that cooler heads must prevail on the South African side, given that there is potential for things to get worse, for the situation to get larger, and for a general deterioration in US bilateral relationships. I just want to lastly say that the G20, the broader G20 progress, as well as the fact that there will be a second G20 foreign ministers meeting in New York next week, will probably be used to sidestep exactly those types of tensions.
Right. Yeah, absolutely. Maybe they can take a leaf out of other leaders' books and actually outright flatter President Trump, which is what we got a good display of in the UK the last couple of days. Ziyanda Stuurman, advisor at the Africa Practice, and Jennifer Zabazaja, thank you so much. Now, for more stories like this around the continent, be sure to subscribe to the Next Africa newsletter on the terminal and our website. You can now also get the latest news from our continent on our weekly podcast by Jennifer, and that is available on Apple, Spotify, and wherever you get your podcasts. And for a deeper dive, catch our TV show, Next Africa, airing on TV on the last Friday of every month. You can still watch our previous episodes in full on your terminal, our website, and on YouTube. Stay with us. This is Bloomberg. More on the AI sector. And earlier this month, Elon Musk briefly lost the title of the world's richest person to Oracle co-founder Larry Ellison. Known for its database software, Oracle has recently found success in the red-hot cloud computing market, competing against the likes of Amazon, Microsoft, and Alphabet. Bloomberg Originals has been looking into how the legacy tech giant became an AI force. Here's a preview.
True to its name, only Oracle seemed to see this coming.
Oracle is having its biggest jump since 1992.
What a blowout quarter for the software company.
Maybe the stock of the year.
And then, just days later,
TikTok's US operations are set to be acquired by a consortium including Oracle.
Oracle shares spike after it's named as part of the consortium.
What was going on? This was an old-school enterprise tech firm, tickling investors in places only a flashy startup normally reaches.
Because Oracle basically said that they have almost $500 billion of contracts to be earned in the next few years. And that was a shocker.
Everyone was modeling maybe, $150 billion.
It blew away analyst expectations.
Now, Oracle's deeply connected to one of the hottest social media properties on the planet, and behind one of the most ambitious infrastructure projects on the planet.
Oracle had been written off as a kind of IBM-like company. This is an incredible comeback story.
Well, subscribers can catch the full documentary right now on the terminal and Bloomberg.com, and it will be up on the Bloomberg Originals YouTube channel later today. Well, we are rounding up what has been a really busy week, starting off with the framework for that TikTok deal, the Fed meeting, obviously cutting interest rates, hinting at further interest rate cuts for the week. This is how major Wall Street indices have performed. So NASDAQ up 1.5%. Take a look at the small cap index, Russell 2000 up more than 3.1% this week. So it wasn't just about Magnificent Seven this week. Small cap also enjoying part of the rally. As for today, things are looking up as well, and keeping a close eye on some of the price action in U.S. 10-year, which has been inching higher. This is where we're at 4.1111. The USD trading sideways, but still weaker on the week. And that is it for Horizons Middle East and Africa. I'm Joanna Versace in Dubai.